Welcome to 3 Minutes of Markets and Money. I'm your host, Lance Roberts. So yesterday, the market set an all-time high. What? Yes, that is actually the point. Markets did close an all-time high yesterday. And what that suggests is that actually the bull market remains intact. I know this is hard to understand here because typically a 20% decline like we saw in March, which was actually 35%, is what Wall Street defines as a bear market. But what I said back in May and what has held true to this point is that this was actually not a bear market. This was just a correction within an ongoing bull market trend. And what would confirm that fact would be a breakout of the markets from that correction low to all-time highs, which has now occurred. Now, this is important to understand here because as a technician and as looking at markets, what defines a bear market is when markets break their bullish trend, which is a rising trend in prices over a period of time. And in 2001 and 2008, that did occur. The previous bullish trend in prices was broken. But looking at the long-term trend of the market from the 2009 lows, what we find is that the trend line of the market was actually never broken by this correction. What had happened here is that the deviation from the market to the actual long-term moving average was actually so great that it required a 35% decline just to get back to that moving average. This was just a correction within the ongoing bull market trend, and now with the breakout to new highs, this suggests that the bull market is in continuation. What that doesn't mean is that the bear market has been forgotten. All this means is that the current first half of the full market cycle is still in progress. This doesn't mean that a bear market has been negated. It simply means that it hasn't occurred yet. With valuations now at pretty much all-time highs, trading at 30 times earnings, and looking at where technical deviations are from long-term moving averages, again, even greater now than it was back earlier this year in February, it's not surprising that we're going to see a bigger correction at some point in the future. What causes it? Who knows? But it'll be some unexpected exogenous event that trips up the market that eventually creates the mean reversion in valuations on a longer-term basis. This long-term trend from the 2009 lows will be broken, and you will get into a full-fledged bear market as we saw in 2008, as we saw back in 2001, and pretty much at every other point in history. That will occur, but is it next month? Is it next year? Is it 5 years from now? Who knows? It will eventually occur, but for now, at the moment, the bull market remains intact, so this keeps allocations to the long side at the moment. Of course, with lots of Fed liquidity, this can go on much longer than people expect. But as John Maynard Keynes once said, the markets can remain irrational longer than you can remain solvent. So pay attention to your money, pay attention to risk, and make sure and keep following us right here at realinvestmentadvice.com and our 3 Minutes on Money every day coming out Monday through Thursday right here, realinvestmentadvice.com. Have a great day.